I think the most important thing, though, is to recognize that while the temperature is being raised on Beijing as we move forward, the Phase 1 trade deal we're assuming is not going to be put into jeopardy. Arguably, that's because, from the White House's perspective, they need those votes in the Midwest. Those are the rural communities that are selling China's their key clients, so to speak. So yes, rhetoric will go up. Yes, it will be quite noisy. But I think there's a natural limit to how far that stuff can go. It will make markets nervous from time to time. We'll have some volatility. But as we head towards November, things will probably die down thereafter.
Stefan, it's Dan here in Perth, and of course as we look at markets, we've just come out of this big period of volatility. There does seem to be signs of stabilisation now. I know the House view in April was to avoid big directional bets. What are you advising clients in this environment? What's their best move?
Yeah, so there's a number of things. Sort of somewhat paradoxically, actually, we still are recommending U.S. equities as the key overweight. At the end of the day, American companies have the flexibility to cut costs when they have to cut costs. When they need to expand, they can expand very, very quickly, and that's something which is fundamentally very attractive right now. So we do prefer that region. On an asset class level, we are balanced between fixed income and equities, so that's also be borne in mind. And then ultimately, it's gold as well. So gold has done extremely well so far this year. We think it can climb higher off the back of this enormous quantitative easing that we're seeing.
What's the optimism in the United States based on? Clearly, the death toll in the US has been catastrophic, and at the same time, the economy also battered and bruised by the overall impact of the virus. What gives you the optimism to say you need to be allocated to the United States right now versus other developed markets?
Well, actually, I mean, it's sort of a fairly difficult exercise, but I think what investors are doing across the board is trying to find the highest frequency indicators that you can. So, the days of focusing on monthly PMIs and retail sales and all those kinds of things are kind of behind us, and you need to dig deeper. So if you look at weekly indicators, so for example, mortgage applications for new homes, that sounds very, very granular, but actually you see a rebound to previous to levels before the crisis. So there are signals coming from the U.S. economy on a much deeper level that the recovery is well on its way. And you mentioned, of course, COVID-19 cases. The case of new infections is actually rolling over in the United States as well. Not as rapidly as in Europe, but certainly it is beginning to roll over. And I think that is where you can find some sense of optimism for the U.S. market.